Are you trying to make bigger profits in your small business? Like many of us, I'm sure you're feeling it. Business is hard. Now more than ever, you need to have a plan to help your business not just survive, but thrive. I'm Marcia Reiner. I'm a business strategist on a mission, and I've helped tons of small business owners to establish and implement a tangible plan that guarantees sustainable profitability and guide your growth. I want to share some strategies that I've earned and learned with you on today's Profit with a Plan podcast. I'm super excited to have my guest today, international sensation, Sydney Wong. Sydney Wong is an author and entrepreneur, and she's been helping business owners to find capital in a time where, they may not know exactly what to do. Her company, VenturX, has been helping small business owners and entrepreneurs to get that capital. And she does it in a very unique way. She's also been bringing transparency into the industry. She's been innovating and defining the gap in the market. There's that bank and the investors, and then where do we all turn? So she's been helping us with that. And she's also revolutionized the startup benchmarks. Her company, VenturX, is a Google Analytics and an angel list. So we're super excited to have Canadian expert Sydney Wong with us. Welcome to the podcast.
Thank you so much for having me. I'm very excited to be here.
Thank you for sticking with me with all the technology issues we had in the first few minutes, but we're kicking through on this. So one of the challenges that I know that business owners have in this time is that they've used all of their savings and funding to get the business to a certain level, maybe 100,000 or a couple 100,000. And in order to scale and go to that next level, they need to look for other funding, investments, SBA loans, whatever it is. Can you tell us how that we should prepare to get our business ready to go out looking for those type of investments?
Yeah, that's a really great question. So as an angel investor, we do get that all the time because there's a lot of, misconceptions and myths about what is it that we really do. So it doesn't really matter kind of what kind of business you are. This goes for all businesses that are looking for capital. You really have to ask yourself, what is it that I need the money for? How much do I need? And why am I choosing this particular grantor or funder or bank that I'm choosing? So make sure that it actually does go with your industry and your type of business. Not everybody's going to be a good match. However, I very much advise do not go with a spray and pray method. Don't just apply to everything and everyone and hope that it makes sense. You really have to come up with a preparation plan for your business and why, this is going to be a good partner for you.
I love that. I'm all about planning. So having that preparation plan, when we're going out and looking for an investment, it's not like your home mortgage where you're just going out and looking for the best rate. I love it that you say that you've got to have the investor or the grantor line up with your business. They've got to have that understanding of what you're doing, and you'll get much better responses if you look that path, right?
Yeah, absolutely. It's kind of more like if you're applying to different universities or scholarships or those kinds of things. So it's not like you're applying for those things that have specific criteria. That has to then match your business. It has to match your business industry, whatever revenue level that you're making. And it also has to match, the kind of person that you want to work with, right? So whether it's going to be venture debt or venture capital or angel investment or bank loan, you really have to want to work with these people because they're going to be there for the long haul for the most part.
That's a good point. You brought up 4 different categories or 4 different types. Would you mind explaining a little bit about what each one has their benefits and maybe ones that you should shy away for certain reasons?
Sure. Yeah. So the first one is a regular bank loan. So for regular bank loans, these are very much more conservative and traditional loans. They're probably the first ones to ever give you loans. And so they are very into traditional types of businesses, like either they're restaurants or brick and mortar shops or mom and pop shops. So these kinds of shops that are much less tech sector related and more into the local community, small businesses, small, medium-sized businesses, and of course, corporations are allowed to have, their variety of different kinds of loans. So these ones, if you don't already have an established business, you do have to have a great credit score personally. So that is very different in Canada and the US, but at the same time, they kind of see them as, a credit score is a credit score. It's great to have a high one, and it's really easy to lose, right? So whatever you do in your personal life, just make sure that, understand that when you're going for your first business loan, if your business doesn't make consistent revenue levels, then they're going to turn to your credit score and probably make you personally liable. So those are the pros and cons. It does really depend on your industry. And, it's really great for people that are, into the community and building things for local services and businesses. And then the next one is venture debt. So venture debt is also a type of debt, and sometimes they also take equity in your company. So they may take shares in your company, but they are primarily there to give you loans as well. But the loans are from more private individuals and sometimes corporations. And so the rates may be different than a traditional bank loan. You may get better rates than a traditional bank loan. So that's great. And it may be way faster to get. However, if they do ask for capital, then you do have to, if they do ask for shares, then you do also have to be careful and see them as more of a partner than something as temporary as a bank. Because that would mean that they're probably going to be on, sitting on your voting board or sitting on, whichever kinds of voting and decision-making process that your company has forever, for the life of your company.
Wow.
And so even if it's just a money injection for a short period of time, this could be there they could be there for the long haul. And they can also renew their debts, right? So you may want a renewal for the next year when you're having more employees come in, or you need to buy that extra piece of machinery, or, for R&D team and those kinds of things. So that's also good and bad too. You have those kinds of choices to make. And then what we do is angel investment. So these are individuals, and they could also be funds that come together. Usually it's for early stage entrepreneurship, when you are just starting out with young companies. For us, it is early stage. So our raise is usually looking at between like 500,000 to 2 million kind of a thing. And we do target US and Canada for VenturX Capital and our angel fund. And then we like to work with venture capital funds, which are much higher levels. So these would be broken down into different series. So they would be a pre-seed, seed, Series A, Series B, Series C. All of this just talks about the stage of your company. And it also talks about the amount you're usually raising. And of course, the higher the letter is, the more money that you're raising. So as angels, we like to look at the leads of venture capital, because our shares only become more valuable if they are going to be raising again and if the company is going to be successful. So we need to always look at the leaders of our industry, which are usually the venture capital investors, to lead the way of being like, okay, AI is going to be really big this year, or biotech is going to be really big this year. And apparently pharma is going to be really big this year. So, these are the kind of things that are what is going to be the next big thing, what is going to be highly invested in, and how easy would it be for these companies to close the rounds and fundraise again, and so on and so forth. And these ones, the difference is that they don't give you loans with interest rates. They only give you straight capital with a percentage of shares, and they will be your partners forever as well. So
that was my next question. So angel investing becomes forever partners as well.
Usually, yeah. You can do like an investor buyout on some special cases, but they're usually there until you are exited. So either a mergers and acquisition or an IPO exit, or
interesting.
One of those.
So it sounds like the angel investor and the venture capital are the angel investor step one for the startup, the early stages, and then the venture capital goes up from there. So it's very similar in that avenue. I didn't realize, that's a big aha for me. I didn't realize that you take an ownership stake in the business and you're there forever. Yeah. I know that like I've worked on a project with a company that was fundraising to buy a piece of equipment, but it had an exit to it. So is that completely unusual to have an exit for the investors, that over a period of 3 years, I'm going to make my capital plus my interest back and then I walk away? Is that ever an option in these kind of lending opportunities?
Yeah, absolutely. So these can definitely be options. And so, depending on who is already on the decision making board, they can say yes or no to these kinds of investments coming in. Personally, I think that having all different kinds of investment terms is favorable, just because you want to be able to have like a variety of flexible options available to you. But these ones that I've just explained are just more the standard ones that are happening right now. And going into 2021, there may be new changes as well.
Interesting. Yeah, it's always an ever-changing market. How's the qualifying for getting the venture type or the angel type vesting versus the bank? Because the bank has that traditional, it's your business credit, and if your business credit isn't stable enough, then they go after the personal guarantees, and so you really have to raise both things up. How challenging is it to get investments from the alternative world?
Yeah, so that's a great question. So we, for example, focus on tech. We actually don't have a lot of biotech for a very specific reason, is because it's very difficult to prove that your biotechnology is going to work, that your pharmaceutical is going to work, and that it's not going to be crushed by the competition. And we don't have experts on our team that specializes in this field. So that is a really big reason why we invest in certain silos that we do, is because we have technology experts that only are able to help us vet how good the product is. But it's not really just about the product. It really is about their profitability plans and projections, right? So we at VenturX have our technology software, which is the progress tool, and we vet their financial runway. How are they doing financially? Are they financially healthy and sound? How they spend their money is how they're going to spend your money. So that is a really great correlation that we show all of our investor partners that are also on the VenturX tool. The other ones are conversion rates, which is how you're converting your leads into sales. So this is talking about all different kinds of ways to convert into sales. Even if you don't have sales, you can have promises of purchase. You can have letters of intent. You can have a Kickstarter campaign. I actually have gotten $1 million for a video game company here in Montreal who was wildly successful with a Kickstarter campaign that was 5 days old. They got $25,000 for making a video of a video game. And then with that proof that they were doing so well, I was able to help them get the next million. So these are the kinds of things that show, hey, people really love what we do. It's okay that you're not in video game, but you probably understand enough that this is a huge amount of, people putting out their money, just like everyday people. That's what Kickstarter is, right? Like your friends and neighbors, really what it is. And they're like, we really want to buy this product. We really want to buy this game. We're going to put money down, even if it's $50 and the actual game costs, like, let's say $200. So these are the kinds of things that are showing proof that there's traction. And so that's really important when it comes to your conversion rate, how well you're converting into sales. If you already have sales and you have monthly reoccurring sales, that is even better because it shows a better profitability pattern. And then the last part is engagement. So this really is more of a tech thing where you have usage and retention. How often are your customers signing back on and coming back to your business, using it again? And how are they using your product or your service, right? So these are the kinds of things that as a blend, we try and focus on. And we try and see, even at the early stages, how are they hitting all of these benchmarks? And are they doing better than their industry average or not? And we're able to then see in a very quick kind of snapshot way what these businesses are about. How are they doing? Is it matching what they say versus what they can prove?
Love it. This is super interesting because it's not the brick and mortar normal way of doing it. And you're looking at this alternative solution. Now, when it comes to financial strength, it's really truly what's on the books, right? And I love your analogy. If you're spending your own money this way, you're going to spend our money that same way or probably worse. So having those having that benchmark in there. But it's interesting because even a consulting firm or an attorney or a chiropractor or a software developer can all use these pieces, the conversion rates on how you're showing that you're getting your next client or next set of clients in. And then I think that's a piece or a tool we should all be working on our business, whether we're looking for investment pieces or not. But I like that that's a benchmark or a measurement of your potential ability to repay that investment. And then engagement can be across many things. Not every company has a reusable product.
That's right.
Or a re-upped or a membership type platform that they would buy in there. So if that, I know you're specifically, tech world, but can you imagine or can you explain maybe if there's another engagement model, if it's not retention's important, but if it's only like, I guess not, because attorney might be one and done, right? Because, if you go in for a criminal case or you go in for a DUI or unless you're in a, business general practice, where you're consulting over a period of time. What else can we use in that engagement to strengthen our business?
Yeah. So one of the bonus marks that you get within engagement is, if people can get there, which will be amazing, is actually customer success rate, which is based on referrals. So is your customer so happy with what you have provided them that they would love to tell 5 other friends about it? Or maybe they're just going to keep it quiet. So you have to really have wowed your first 100, your first 1,000 customers to the point that they want to talk about you and they want to refer more people to you. If they're having this problem and it's a problem that you solved really well, then of course they would love to talk about you to other people who they know have had this problem as well.
No, that's brilliant. That's brilliant. So when you say we've met these benchmarks and we're out there, we've found a company, angel investors possibly that want to invest in our company, how intrusive do they get into my business in the qualifying process?
So you really have to be careful about who you're talking to, what their reputation is, and ways to protect yourself. So it is very gray area for sure. They can go as far as, let's say, calling up your clients and customers to really ask, are you happy with what they're providing? Yes or no? Can you give me some feedback? And then that's something that you have to also be careful of too, right? Because what if they only chose the customers that are your first few customers and it wasn't even close to the product that you have right now? That's very possible. And it doesn't even do the same things. So that's possible. Another way is they really do want to test the relationship you have with your co-founders. So who on your team, are the experts in their field, and how are they the experts in their field, and how do you guys work together? Have you worked together for a long time? Yes or no? But as much information as you feel comfortable providing is great, of course. If they have already, and this is something you can find online, if they've already invested in your competitor, you might not want to provide so much competitive information about why your product has the secret sauce. You know what I mean? But at the same time, they are allowed to ask for it. So it's really up to you to really balance that negotiation.
Great points. Great points. So when we're talking about financials, do they want 3 years? Do they want 1 year? Are they going to look at bank statements? What are they looking for in the financials that when they ask?
That's a great question. So we have something called QuickBooks, which is an API that does plug into our VenturX tool. So then you actually don't have to worry about putting things in all of the time, right? But they would only kind of draw a red flag if, let's say, you drew out an extraordinary amount of money and then went into like the negative for 1 whole month. So those are the kinds of things that would like draw red flags in terms of your financials. But for the most part, on the flip side, it's really about your monthly recurring revenue. Is it going up every 2 months, every month? Is it staying the same? If there's a dip, why is there a dip? Or the annual recurring revenue, ARR. So this would be in different kinds of businesses, like Airbnb would be an ARR type of business because people don't go on vacation every month. They probably go around the same time every year. Right. And they will then be booking things on a yearly basis. And then it's kind of your job to see, the founder's job to see, is it the same people or roughly the same age group, roughly the same demographics, booking around these times every year for the same kinds of cities every year. And that is how, you would normally do that.
Interesting. Okay, good. So, all right. So we've talked about financials, conversion rate, engagement. We've talked about different kinds of opportunity to raise capital. What else should we know about as business owners in the ways to prepare for asking for capital?
Yeah, so we have on our blog, which I can send to you, it's blog@venturx.ca. So on our blog, we also have it on Medium as well. It is an entire data room file. So a data room are all of the documents that you actually need. So it's everything from the cap table to the business plan to the pitch deck, which is the PowerPoint version of the business plan, and then your customer agreements and your employee offer agreements and your employee kinds of contractual partnership type agreements. So these a list of huge documents are actually all templated for you, and they're free and available to you. So making sure that you are doing that practice exercise where you fill all of these out just for yourself, you'll be able to have a great snapshot of really where you're at and who is on your decision-making board. Why are they there? Should they be getting, this much percentage? And then who else is on my board in terms of the investors? And, are they able to provide me more opportunities in my industry in the future, or are they industry experts? These first few employees, why they're there, and what are they providing that no one else can provide? Do I have the strongest team I could have? So this is a really great way to, one, prepare all of the documents you actually will need when you go into a room with any investor, but also be able to have an honest conversation with yourself and your team about where your business is at when you're looking for capital.
Love it. Reminds me of Shark Tank. And I'm sure you've never heard that one ever, right? That you're coming in and you're presenting your pitch and you're saying, wow, this is the wonderful product, service, or widget that I have. And this is where I think it's going to go. This is where we have been. So it's getting all the documents that line all that up. Now,
Yes.
Here's the question that I'm sure you've heard before. What is what's that ratio that they always talk about? And you're saying, well, if I'm making, $300,000 a year every year, and so I'm asking for $1 million, that's three and a quarter times the amount of, is there a magic ratio that you look at versus how much you're earning to how much you could ask for?
Yeah, so that's a really great question. And honestly, there isn't a real way to calculate valuation in an appropriate way. But being somebody who has clients in both the US and Canada, and as well was expanding into Asia last year when I was speaking at Hong Kong FinTech Week, the things that I've learned is that it really actually depends on where you're asking money from. So, in Canada, we have a lot of companies, and they do ask for less money than if you were in, let's say, Hong Kong or in the US. In the US, your valuations are much bigger. And that is also why there are some investor colleagues in the States that are looking to invest outside of the States because they find it to be too expensive now to invest in the States because of the way that the media is or the way that the culture is much more, higher valuation, but not as much profit. So they don't find that ratio to be as fair as if they were to invest in other places, which is actually why we're getting so many partners because we're getting a lot of requests for that reason. And then in Asia, there will be either the huge extremes. You're going to ask for way too little that we can't even possibly entertain that amount because it's way too little. Or you would ask for an outrageous amount, and then one investor would fight to have all of it. So they would want no other investors in the round. So Those are very extremes. And these are all very different ways that you would see the same thing. And you can have just as great companies in Australia or Canada or the US, but they would all be at different valuations. So it's really up to how savvy you are or how resourceful you are to partner up with the right people.
Excellent. Wow. It sounds like that there's opportunities for investing as well. If you've got a little bit of capital, you can go in and become part of a group of investors that buy these investments. I've had guests on that talk about investment opportunities as well. So it's good. So okay, so there's no real So you answered it kind of vaguely, but is there like a 2-to-1, 3-to-1? What's kind of the bottom benchmark and what's kind of an average benchmark for that evaluation versus income?
So that part is really difficult. Like if you have a small market and then saying that like a small market, meaning in the millions of people, like that's really small, but your ratio is like 1 to 10, like you're, I don't know, 100,000 in revenue, but you are going to 10x it for the valuation that you think your company is worth, then that is probably crazy because you know that you can't actually sell to 100% of the market. You're probably going to sell to like 5% of the market, and that's like super generous for a startup company, right? And like Google does not sell to 100% of their market. So why would you? And so it's that kind of a thing that it does depend a lot on what market that you're in. That would determine which ratio is really fair. No one's going to choose 1-to-1, but choosing 1-to-10 for a small market makes no sense. Choosing that for a huge growing market, that's okay. I think something like Uber is 1-to-60.
Wow.
Yeah. Because they're counting all the cars that ever exist in the world.
Gotcha. Yeah.
Their growth rate is faster than anybody else in their industry.
Okay.
So is their technology better than their competitors? No.
Same thing.
When I took Uber in California, when it was first coming out, they could not find where I was, no matter how good my GPS was. They were always on an overpass. I don't know why. So was their technology better? No. Is it getting better faster than anybody else? Yes. And are they growing faster than anybody else? Yes, but they're not changing the number of cars that exist in the world. So then it's up to the investors to say, okay, 1-to-60, is that fair?
Right. Interesting. So when we're asking, so say we have a 1-to-3 or a 1-to-5, we'll round it and say 2 times what we're asking for. What kind of expectation in the ownership percentage would that come back with?
Yeah, so that is a lot more standard when it comes to, especially in Canada and most places in the US, where about 15 to 20% is pretty average actually for all of the rounds. And the reason it's like that is because actually you get diluted in every round. Right. Mm-hmm. So if you were the first, ones that were investing in Uber or Skype or, Microsoft, then you got diluted every time they raised more money. And they're expecting that. So as angel investors that are early on, we are expecting to be diluted every single round as you're raising more and more money. And so having that standard-ish amount for this, every single stage is fine. But what you were seeing on Shark Tank or in Canada, Dragon's Den, also started by Kevin O'Leary, I think. He's from Montreal too.
Okay.
So what happens there is like, of course, you can ask for any amount in terms of the ownership and the stake, but then you take on some responsibility to either find investors for this company, you as the investor, or you will be reinvesting in all of these rounds.
Gotcha.
For purchase orders or for new equipment, new technology, more staff. So then,
the risk becomes for the investor too, because they become a viable portion of the ownership, and therefore they're taking on the risk of all the other investors coming in.
Yes, exactly. So they can't just let the company be in the negative if they're the only investor at like 40% or 60%. But if you are those normal ones that are being diluted every round and that they are raising again, then it's not really up to you to reinvest. Of course you can, but you don't have to because you're going to be diluted every round.
Okay. So we've talked a lot about the venture and the angel type investing. I know that that's your wheelhouse, but is there anything that we should know about maybe not going with the traditional banks, or maybe taking traditional banks over the angel or venture style investing?
Yeah, so the funding, there's alternative funding as well that have come up over the years that become really, really popular. So one of them that we talked about was the crowdfunding platforms like Kickstarter. So if you do have them in your area, you want to test out your idea without actually putting a lot into it yet, then I highly suggest those kinds of platforms, either Kickstarter or one of their competitors. GoFundMe is another one, Indiegogo, I think. There's also crowdfunding for equity. So those are also everyday people. So you can just choose your family and friends if you really want to, and they'll all have like a minor stake in your company, and you're creating this online campaign, same way Kickstarter is. But at the end of it, they will get a percentage of your company, and it's all the people that you know and the friends of friends or whoever it could be. It actually could be whoever. And but the point is that these are more everyday people, and they're not, necessarily investors every single, as their full-time
experienced
job.
or accredited investors.
Yeah, exactly. So these are great alternatives as well for any type of industry. You can do this.
I think it's a neat idea. I think when you start getting into the crowdfunding, it could probably get messy because they're inexperienced and so on, and you're inexperienced in the first place going that path. But I think that it just makes sense that if you're going to grow your business, you also want to, quote, sell stock in it. And that's what publicly traded companies do. And therefore, once they shift from private to public, they now have to disclose certain things. And there's challenges that come with it. But that's the trade-off of asking for money from someone to expand your business, whether it's Uncle Joe or the angel investing type world. That if you're asking for money, you have to open your kimono, and you have to give a little bit of stake in it. So it becomes now you're thinking like a publicly traded company, even though it's private investment. So it's the same kind of rules. You have to pay shares and dividends and part of your profits. And that's all it is. It's the normal of business.
It is. And actually, like, in a way, for certain types of personalities, it could make you feel more motivated to aggressively accelerate your business, because you want to make sure that everyone is happy. You want to make sure that your family and friends who've invested in you are proud of you and see that you're moving forward. And so all of these things could also in turn light a new fire inside you too.
Right. And so one more little piece on here. What about organizational structure? Whether you're an LLC, a C Corp, an S Corp, a sole proprietor or partnership, do any of those have to be set in place prior to getting or going out and getting funding?
So not really. You can though, because there are people who have definitely done it with just an idea, and that has happened before. But it also does depend on when you are. So there is a trick to getting certain grants and things like that too. So if there's a government grant or whichever, you have to be under a certain time frame. So you have to be less than 2 years old, less than a year old. And that counts in terms of when you've actually incorporated. So you may want to time it that way to get certain, funding and money and things like that there, where you would then qualify for these things and then incorporate it. But you can also look out for investments and see if the investor is asking you to incorporate first or not. But all of that does depend. So you can definitely plan it out so you can maximize your chances, because you don't have to run out and incorporate for no reason. That's not the point. The point is to kind of see if you are building a viable business and therefore needs to go through steps, X, Y, Z.
Well, it just caught me in the shares in the type of stock, and giving a portion or equity in your company, that you want to have some legal structure and some legal agreements in it. And if you're a sole proprietor and now you have these equity pieces, you're no longer really a sole proprietor. You become a partnership where you're the general partner, and these people are limited partners only to the investment that they have. So then it becomes kind of technical on that. And so I was kind of going, where do we go there?
but you kind of want to see what you're really going to end up with. Because
before you start jumping through burning hoops, right? I gotcha. This has been a great conversation. It's been very enlightening. I really didn't put two and two together on the angel side and the venture equity side that I'm actually going to have a lifelong relationship with the investors. But I think that and then it shifted for me and said, well, wait a minute, this is the normal business on it. You can always buy them out or have, agreements in there. It's the normal trajectory of business. You start small, you grow your ownership, and eventually you go public. It's just the normal stage of a growing business. So it makes a lot more sense. You made it very enjoyable and simple. And where can listeners find out more about VenturX and you, Sydney?
Yeah, so I am available on LinkedIn. We host a webinar every month or so to actually help startups with these kinds of things. I'm also very active on social media, or you can shoot me an email at sydney.wong@venturex.ca.
Perfect. So listeners, thank you for listening today. I hope you found an idea or two to put into your business now to prepare you for the future of things to come, and to really consider using one of my favorite strategies, which is other people's money, to help you become more profitable. So considering what's happened to businesses over the last year, now more than ever, it's important that you have your own profit plan in place so that you can have a thriving business. I've got 6 easy action tips that you can put into your business immediately so that you can see that impact. So go pick that up at failproofbiz, that's biz.com, and pick up that free report. So Cindy and I would love to hear your questions, any feedback, or even ideas for future shows. Please subscribe and comment on today's podcast. And as always, you can catch Profit with a Plan on any of your favorite podcast players. And we're looking for more great profitable information on next week's show. So until then, make your plans and profit with them. Thanks, Sydney.
Thank you.